The picture is becoming less murky, but let's bring it into total clarity by finally looking at their asset positions. Fred, his home with no debt is worth $570,000. His investment property is worth $380,000 minus the debt of $195,000, so his asset position in the property is $185,000 and his car is worth $8,000. This makes Fred's net worth $763,000. Let's have a look at John's net worth. Home $1.5 million, debt $1.2 million, his asset position in his home is $300,000. His investment property, remember, is 100% geared, no equity. His car, leased, no equity. His credit card debt, which is why he can spend more than he earns, is $51,000. This makes John's net worth $249,000. You will recall from last week that Fred was able to save $34,000 annually from his income, whilst John, who was trying to support a lifestyle beyond his earnings, was actually going backwards by $34,000. This explains the credit card debt, as I said earlier. Clearly, our accepted definition of wealth is not accurate. Wealth is the abundance of valuable resources or material possessions. The word wealth is derived from the Old English wheel, which is from an Indo-European word stem. An individual, community, region or country that possesses an abundance of such possessions or resources is known as wealthy. That's the definition from Wikipedia. An abundance of valuable material possessions or resources, riches. The state of being rich, affluence. That's from thefreedictionary.com. Essentially, wealth is the accumulation of resources. People are said to be wealthy when they are able to accumulate many valuable resources or goods. That's from Investopedia.com. Clearly, in our example, John has an abundance of material possessions, yet in no way could he be defined as wealthy. Welcome back. As you remember, we're dealing with accumulation, and Chris Carroll from Vista Financial Services has agreed to join us as a reverse interviewer. Hi, Chris.
Hi, Kerry. It's a pleasure to be here.
Thank you. What do you think we're missing? What information do you think we should be providing?
I think it's important that clients fully understand the different types of investments to build up their wealth during their lifetime. Can you just re-clarify the major types of investments that they can undertake?
Sure. There are two major types of investments. There are income investments and there are growth investments.
Can you elaborate more on the type of income investments?
Yep. Income investments basically are investments where you put in your money and the money stays but an interest is paid on it. So with an income investment, typically if you put in $100,000, in 10 years' time, if you've taken the interest and spent it, you've still got $100,000. And income investments are available in a number of different types. So there's just cash in the bank, it might be, 1% interest. It might be a term deposit, the interest rate might climb a little. There are cash management accounts. There's lots of ways to manage cash. And then of course there's bonds. So bonds are where corporates or governments borrow money from an investor and offer a fixed interest rate for a fixed term.
In the current climate, are bonds considered a safe investment?
Bonds can be safe. There's lots of different grades of bonds, and maybe the viewers have heard of junk bonds. They're, I think, triple C down. So they go C's all the way through to double or triple A's, depending on who the rating agency is. So in Victoria, viewers would remember Jeff Kennett wanting a double A credit rating. Well, all that means is that he can borrow money through his bond at a cheaper rate because the security of the bond is incredibly good.
Which is important to cash flow, but not as good to investors if the rate is lower.
Absolutely, yeah. In terms of growth investments, they are typically places where you put your money, 100,000, and a number of years' time, the value of your investment has changed, either up or down.
And the main types of growth investments?
Okay, so two major types. There's shares and there's property. Property is accessible in a number of ways. Direct property, in other words, you own it, or indirect property, where a fund manager or an investment manager buys the property for you.
And what type of properties does that fund manager invest in?
They can invest in anything, including residential, but mostly they're commercial or industrial properties. So if you were to buy a property through a fund manager, you might have a 20-acre industrial estate in an industrial area, or a city building, or something of this type.
Okay. And what about shares? What do the fund managers normally invest in? What type of shares?
Okay. So shares, as the viewers will be aware, you can buy shares on the share market. So you could rock up to your stockbroker or your discount broker and buy 200 Myer shares if you wished. And that's direct ownership. So the viewer might say, look, I've got a spare grand, I think BHP is going to do pretty good, and they'll speak to their discount broker or whatever, or buy them online, and they own the shares. A fund manager does exactly the same thing, but hopefully with a little bit more skill. So, and also with much greater diversity.
And the fund managers restricted to Australia shares only?
Fund managers aren't. There are fund managers that specialise only in Australian shares, but mostly fund managers have a range of shares. So a fund manager pools money and buys a portfolio of shares in any market. So they'll put a label on the fund they sell you. So it might be Australian shares, in which case if they're true to label, they'll only buy Australian shares. Mm-hmm. If the label's international, they'll buy international. If it's a global mix. So the fund manager intercedes between the investor and the direct share ownership to create a portfolio which the fund manager hopes will give value to the client.
With shares and the current turmoil in the global economic market, what would you be saying to clients or people who are holding shares?
I'd be saying there is no market that's a bad market for share ownership. People who can guess market movement will do better than those who can't, but I don't know anyone who can guess market movement. So if you own shares, my advice is always keep owning them, but there's another proviso. There's nothing wrong with shares as an item or an asset to own, but if you've got money in shares, own the correct shares. So if a company is not impressing you with their performance, sell them and buy a company that will impress you with their performance, but still stay in the share market.
A lot of people would not understand that they own shares within their super fund. Can you just elaborate a little bit more as to the difference between super investments and normal investments?
Yeah, sure. And that's an excellent question, truthfully, Chris, thank you. A lot of people think superannuation is an investment medium or a product. It's actually not. It's only a fund manager doing as I've described. So a fund manager collects the money and invests in a portfolio of shares that he thinks will add value in the categories we've discussed. When we call it a superannuation, all that means is it's exactly the same thing, but run under a different tax regime. So contributions to super are deductible to the employer rather, or if you're in your own business, to yourself. And there's different tax treatments throughout the superannuation fund. There's restrictions on when the money can be drawn. So it can only be withdrawn, for example, on disability or death or at retirement. So because of the tax advantages that are given for superannuation, the government imposes restrictions on its use.
Yep.
And mostly the people who use super think that that's a fair trade-off. But I come back to the same point. It's a managed fund run under a different regulatory and tax regime.
Yep. So it is an important part of any wealth accumulation strategy.
Absolutely. Yep. Wealth should be accumulated for all purposes in life. So we should accumulate it for the swimming pool if that's important, the overseas trip, education. But of course we're all going to get old eventually and we'll need money to live on then. Chris, thank you very much for joining us. Thank you very much for your help in clarifying issues around accumulation funds.
Once again, enjoyed it.
Good.
Thanks, Kerry.
Thank you very much for being with us at Wealth Plan TV. That's the end of our accumulation session. Next week, we'll be looking at risk. Please join us. Don't forget our competition. Please go to the website and sign up for our 100 Goal Challenge. Prizes are being generously awarded by AIA Australia, who are giving a free risk assessment away every week, and 2 iPads to be won throughout the series. And also Keith Abraham, who's donated his book about finding your passion. Go to the website wealthplan.tv. Thank you for joining us on Wealth Plan TV. I hope you enjoyed the show. Next week, we'll be dealing with risk.